Hello, I'm Ross Mould, AJ Bell's Investment Director, and today I'd just like to bring you up to date with the Bank of England's stress tests and also the latest financial stability report, just for any possible implications for your portfolios, particularly if you own banking shares. Okay, the stress tests first. These are all about how much capital the big 7 UK banks have relative to their risk-weighted assets, loans against quality of assets, and how much pain they can take in an extreme scenario before they have to come back to you and me, possibly for more taxpayers' cash. Now, the great news is all 7 big banks passed. Nationwide and Lloyds were the strongest. Royal Bank of Scotland and Standard Chartered sort of scraped over the line thanks to some remedial work that they've done this year. But nevertheless, all 7 passed a very vigorous stress test that looked at a property collapse in the UK, a Chinese downturn, a collapse in Hong Kong property, a weak oil price, rising US interest rates, you name it, they pretty much threw the sink at them. And I think the fact that they're able to stand that will offer some reassurance, certainly relative to European banks, where last year's stress test was really a little bit more of a tickle. Now, the financial stability review is a little bit different. This introduces the concept of possibly an extra capital buffer on top of the ones demanded by the stress test, known as the counter-cyclical buffer. It may be 1% of the balance sheet, designed to help the bank see them through a really tough time and maybe even start lending during a recession when things are particularly tricky. Now, a lot of people are expecting that number to rise quite quickly. It's been kept at 0 right now, may rise to 1 at some stage in the future. I think actually the banking stocks are responding favourably to that today. People thought the Bank of England may insist on something a lot more quickly. So 3 implications from all of that. 1, bank share prices are up this morning. They think that it's good that they've passed the tests. And 2, that the counter-cyclical buffer isn't being imposed right now. 2, the government will be absolutely thrilled to pieces that Lloyds has passed with flying colours. It makes it easy for them to sell their final 12% stake in the bank next year, complete with £2 billion to retail investors, and it also gives Lloyds freedom to pay those juicy dividends that will probably form part of the investment case. And 3, just don't forget, regulation isn't going away. The counter-cyclical buffer is there. There's another stress test at this time in 2016. The regulator is going to keep the pressure on. So these banks are going to find it hard to grow earnings. It's a mature market, it's a competitive market, it's a tightly regulated market. They're complex companies still, so you do need good reasons to own them and you must understand them. And also think, on balance, earnings growth is going to be hard to come by, and as a result, therefore, it's going to be income that may be the key. So watch those dividend payments, and at least the stress tests show today they're capable of paying them. Thank you very much for your time, and we look forward to keeping you in touch.